Namaste students. Today we are going to discuss the computation of interest on drawings. Here we go. Let us understand the term drawings. Actually, the word drawings in accounting means money, goods or property of the business which is being used for the personal use of the business person. So this term was already introduced to you in the study of your earlier year first pre-university. So drawings refers to either money, goods or property that belongs to the business unit but is being temporarily used by the business person. You must also recollect the entity concept over here. Though you are the owner of the business, though the businessman owns the business unit, the business unit is very different from that of the businessman. So if the same businessman, so-called owner, takes out the property or money belonging to the business for his personal use, it is to be referred as drawings. Now in a partnership firm, what happens is, if the partner is in need of any money from the business, he would draw the money against the profits of the firm. So this money being withdrawn by the partner from the business unit is to be termed as drawings. Now this drawings would cause a loss to the business because that much money becomes less in the business unit to be used in the business. So naturally, to keep a control or a watch on to stop the overdrawn money by the partners from the business, a certain nominal interest on drawings will be levied. So this will be levied as per the partnership deed that is made among the partners of a partnership firm. So here also understand students that only when the partnership agreement provides for the levying of the interest on drawings, then only interest on drawings can be levied. Or otherwise, in the absence of partnership deed, the firm will not be able to collect any interest on the money withdrawn by any partner. No interest on drawings is charged if no express agreement. What is this express agreement? It is nothing but partnership deed. When the partnership deed is missing, no interest on drawings can be levied on the partners by the partnership firm. If there is a deed, whatever percentage is provided as per the deed to be put as interest on drawings, that much could be collected by the firm from its partners. Now, here usually the interest rate is expressively agreed upon by the partners. That is why I said whenever there is a provision of levying interest on drawings upon the drawings on the partners, where will you find the interest rate? It would be given in the partnership deed. So the agreement will provide you what is the required rate upon which that this interest has to be cast. Also understand students, this interest on drawings is considered as an income to the firm. The flow would be the interest on drawings is paid by the partners to the partnership firm. Well, what are the journal entries in respect to this interest on drawings? So there will be two steps that needs to be followed in the accounting treatment. Primarily, you have to charge interest on the partners' drawings. When we are charging the interest on partners' drawings, the partners' drawings would be taken to their personal accounts. Actually, in the forthcoming lectures, you will know what these capital and current accounts of the partners stand for. They represent the personal accounts of the partners. So each partner's capital or current account debtor to interest on each partner's drawings account. The capital or current account representing the personal accounts of each one of the partners. And this interest on each partner's drawings account being a nominal account, automatically has to be closed at the end of every year. So in order to close this interest on each person's drawings account, the entry would be interest on each partner's drawings account data to profit and loss appropriation account. So here profit and loss appropriation account represents the extension of the profit and loss account that will be prepared exclusively for partnership as well as for any joint stock company. So let us recap the journal entries. So the first set of entry would be each partner's personal account, or you can call it as capital or current account data, to interest on each partner's drawings account. This entry is passed for charging the interest on partner's drawings, and when this partner's drawings, the interest on partner's drawings is transferred, the transfer entry would stand as interest on each partner's drawings account data to profit and loss appropriation account. Now, let us begin with a study on the computation part of interest on drawings. Interest on drawings can be computed using different methods. In our syllabus, we are given 3 methods on which we can compute the interest on drawings. The first method being direct method or specific period method. The second method as product method, and the third one stands as average period method. Another name by which it is called is shortcut method. Because it is easy to compute the third method, we also call the average period method to be a shortcut method. So let us analyze each one of these methods in detail with ample examples. Well, students, the direct method is a very easy way of computing the interest on drawings. Actually, in the examination, this method, the questions on this method will not be framed. This is only given for our understanding purpose. So once you are able to understand how this computation of interest on drawings happens, normally, practically speaking, as well as for the examination point of view, we use either the product method or the shortcut method. Anyway, to understand, let us proceed with an example and to the method on how interest on drawings would be computed using this direct method. There is a very simple formula that is being used in the computation of interest on drawings under this direct method. Interest is equal to amount of drawings into rate into number of outstanding months by 12. So here when you read this formula, you know what interest stands for. It is IOD, interest on drawings. Amount of drawings represent the total amount that is withdrawn by any partner from the business during a given period. Rate is an indication of the interest rate that is usually given in the form of percentage. What does this number of outstanding months stand? It is the period between the date of withdrawal and the closing part of the year. Imagine, usually you know what a financial year bracket stands for. It is from 1st of April of one particular year till it ends with 31st March of the consecutive year. That is the next year. Now imagine a partner has withdrawn certain money on 1st of April. So he has used this money for all the 12 months of the year. Naturally, the outstanding months would be from 1st of April till 31st of March. And again, if a certain money has been withdrawn on 1st January, imagine that the drawings happened on 1st January. So only 3 months period that the partner has used this money from the business for his personal use. So the number of outstanding months would stand as 3. So I think you must be knowing what this outstanding period or outstanding months stand for. It is the period from the date of withdrawal till the year end. So once you are able to calculate the interest on drawings on this method, we accumulate the interest. Supposing that the partner has withdrawn monthly, every month we calculate the interest using the simple formula and add back all the interest put together would be our interest on drawings. So usually this method is avoided because if there are frequent withdrawals made by the partner, every time he withdraws, every time you may have to use a formula in the computation. This method is quite lengthy and also error prone. That is, numerical disadvantage would happen if you are computing repeatedly several times the interest on drawings. Anyways, we will just look at one very simple example. Though it is not being asked in the examination, still let us analyze one very simple example on the computation of interest on drawings using direct method. Here goes a particular sum. Shaker, a partner of a firm, has withdrawn the following amounts during the year ended 31st March 2014. So there are three different dates that is being given to us. On 1st July 2013, 5,000 rupees had been withdrawn. On 1st November 2013, 3,000 rupees had been withdrawn. And on 1st January 2014, 2,000 rupees has been withdrawn. And our question says, calculate interest on Shaker's drawings at 6% per annum and the accounting year ended 31st March 2014. Now you must be having a mind map, students, that what is your financial year given under the question for calculation. As per this example, you can analyze. It starts on 1st of April 2013 and ends by 31st March 2014. This period must be very clearly drawn up in your minds. Now, proceeding to the computation of interest on drawings, which is given at 6% per annum. Now, look at the computation part. You know the formula. Interest is equal to amount of drawings into rate into number of outstanding months by 12. So here, let us take the first part. On 1st July 2013, 5,000 rupees has been withdrawn. So 5,000 rupees being withdrawn on 1st July. You take the first set, amount of drawings is 5,000. Date is common, 6%. So percentage will be denoted by a denominator of 100. So you have to write it down as 6 by 100. And what is this number of outstanding months I told you? From the date of withdrawal till the year end. What is the date of withdrawal? 1st July. And what is the year end? 31st March. So how many months, number of months exist between 1st July and 31st March of 2014? Let us begin the count. July, August, September. I am talking for the year 2013. October, November, December. So 2013 has 6 months and again proceed January, February, March till March of 2014. So how many months is the outstanding period here? 9 months. So from 1st July 2013 to 31st March 2014 is a period of 9 months. So that is why we took here as 5,000 into 6 by 100 into 9 by 12. Similarly, for each one of the withdrawal, you may have to extend your computation. The next part of the question says on 1st November 2013 that Shaker has withdrawn rupees 3,000. So here again 3,000 into 6 by 100 is your rate as usual, but number of outstanding months differ. It starts from this time from 1st November, which happens to be the date of withdrawal. So to count November, December, Jan, Feb and March is a period of 5 months. So naturally 3000 into 6 by 100 into 5 by 12, that gives you 75 rupees. Finally, Shaker has withdrawn on 1st January 2014 rupees 2000. So this time from 1st January 2014 till 31st March 2014 stands a period of just 3 months, Jan, Feb and March. So 2000 into 6 by 100 into 3 by 12. So that gives you a total of 30 rupees. Now what is the total interest on drawing, students? You may have to add back all the 3 numbers. 3 withdrawals had happened. So therefore the interest for all the 3 periods are to be added. 225 plus 75 plus 30. That gives you the total interest on drawings to be 330. Hope you have understood very well this example. But have you noticed that there is a tediosity in the computation? Every time you have to apply the formula carefully, the number work has to be done repeatedly. And one more disadvantage is if the partner is withdrawing too many times. Let us imagine monthly is withdrawing. That means 12 times in the year is withdrawing. Or rather, every month twice is withdrawing, which makes it 24 times. The computation becomes really strenuous. That is why this particular method is avoided. Practically speaking, we follow either product method or shortcut method. So I hope you are clear with the understanding. Now I am moving on to the discussion on product method. So what does this product method mean to us? Under this product method, interest is calculated on the total product of the various drawings made by a partner during a particular year. So here, specified rate of interest, as like how we saw in the previous method, we will have as per the agreement given a specified rate of interest. Here also we may have to compute the number of outstanding months. But instead of calculating the total interest on drawings for every withdrawal, instead we use a small technique of finding out the product. What does this product indicate is, it is the multiplication between the amount withdrawn and the number of outstanding months. So when you take the product of these two terms, which is termed to be product itself, using this product, instead of calculating so many number of times the interest on drawings, once for all this IOD can be computed. So here we follow two very simple steps in the computation of interest on drawings under product method. The first step, the total product of various drawings during the accounting period should be derived. So this is like every product has to be, as I told you, what is product, students? Product is the multiplication of two terms, amount of withdrawal with the outstanding period. Generally, outstanding period is stated in number of months, because we at PU level go with the computation of months as our unit for the computational purpose. Once you finish finding out the product on different drawings, then you have to total that up where you get the total product. Then once you are able to find the total product, then you have this simple formula. Interest is equal to total product into rate into 1 by 12. What is this 1 by 12? It represents the average of 1 month being taken for the computation on interest on drawings. So quickly to say, we have two important steps in the computation of interest on drawings under product method. The first step, first we find out the product. Product is equal to the total amount withdrawn into this outstanding number of months. That would give you the product. After computing the product, take the total product. That is, sum up all the products and that would give you the total product. Total product into rate into 1 by 12 would give us the interest on drawings. So hope you are very clear in the computation. Let us also see a quick example on this particular computation of interest on drawings under product method. Well, students, the method will be specified to us. Very clearly, it would be specified to us. And in the absence of the method being specified, many times or rather all the times that the method has to be mentioned in the question. As per the question paper, I am talking from the examination point of view, the method would be specified. But in case, in the absence of the method being given, then you may have to drop whichever method is convenient for that question. I will tell you at the end of summarization, I would tell you which method has to be followed in the absence of the specification given as per the question. Well, let us move into this simple example. Uma and Suma are partners in a firm, sharing profits and losses in the ratio of 3:2. Uma withdrew rupees 3,000 quarterly at the beginning of every year. Calculate interest on Uma's drawings at 8% per annum for the year ending 31st March 2014 under product method. There are three parts of the question which we need to understand very clearly. What is the frequency of withdrawal? See, there are two types of drawings that happen. One is at frequent intervals of time. The other one is whenever the partner is desirous of drawing the money from the firm. So, this particular question emphasizes on regular interval drawings. Every quarter that the partner is withdrawing, quarter indicates 4 times of the year. And we have 12 months in the year. When 4 times it is withdrawn, what is the frequency in which the partner is withdrawing the money? 3 months once he is withdrawing. So this is one part of our understanding. And then it also says the question at the beginning of each quarter. So you must catch hold of what is the starting date of each quarter. When I say 3 months once, could it be the beginning or middle or even at the end? So you must be very clear with at what part of the quarter that the withdrawal takes place. The third important information is upon rate of drawings and also the amount of drawings. Amount being 3,000 every quarterly being the same, and the rate is going to be 8% per annum. So there is a table that needs to be drawn on the solution part. Whenever it is product method, it is always preferable to draw a table. The table will have these stubs, headings. Date of drawings. Date of drawings is not provided to us. If it is irregular drawings, they would tell you when and when that the partner has withdrawn the money from the business. But being regular withdrawal here, only the information shared to us was every beginning of each quarter that the partner has withdrawn the money. So in such a case, we may have to go with the date of withdrawings being taken by us ourselves based on the information given. So when it says beginning of each quarter, you first divide 12 months into 4 parts. So here 12 months divided by 4. You get 3 months. When are you going to start? April. So April, May, June is first quarter. July, August, September is second quarter. October, November, December is third quarter. Jan, Feb and March of the consecutive 2014 becomes your fourth quarter. Now pull out the beginning dates. When I say April, 1st April. And then when I say July, it will be 1st July. When I say October, it should be 1st October. And naturally, January indicates 1st of January. So that those are the dates of beginning of each quarter. I think the first column is clear on your understanding. Next is amount of drawings. It is given 3,000. So therefore, plot 3,000 on every case. And number of outstanding months, always when you have already drawn up the date of withdrawal, from that date till 31st March. 31st March of whichever year you are talking about. Here assuming that 13-14 happens to be the financial year, which I have taken in the example, my year end is 31st March 2014. So how do I calculate number of outstanding months here? 1st of April 2013 till 31st of March 2014. That gives me a count of 12 months. Similarly, 1st of July 2013 till 31st March of again 2014. The same year end is going to be the same. So that gives me a period of again 9 months. If you want, you can count July, August, September, October, November, December, Jan, Feb and March. That gives a count of 9 months. Similarly, the third quarter is from 1st October till 31st March of 2014 and the last quarter begins on 1st of January 2014, ends by 31st March 2014. Now, I hope your second and third columns are very clear. The first column indicates date of drawings, the second column indicates amount of drawings and the third column tells us about the number of outstanding months. The fourth column is a representative of the product. Product is given by the amount of drawings into the number of outstanding months. Or rather, to say precisely, it is column number 2 into column number 3. So in the first instance, you find in column number 2 the amount of withdrawal 3000 into 12. That gives you 36,000. Similarly, 3000 into 9 is 27,000. 3000 into 6 gives you 18,000 and 3000 into 3 gives you 9,000. So product is equal to amount of drawings into number of months outstanding. Column number 2 into column number 3. Once students you are ready with the products, what is the next step? You may have to add back the products. 36,000 plus 27,000 plus 18,000 plus 9,000 gives you 90,000. So what is this 90,000 called as? Total product. Now let us move into the last step of our study. Interest on drawings is equal to total product into rate into 1 by 12. Total product is 90,000. Rate is given at 8%, meaning 8 by 100. 1 by 12 is a constant which you have to use as per the formula. So let us substitute. Use a calculator. 90,000 into 8 by 100 into 1 by 12. So our interest on drawings is going to be 600 rupees per annum. That is for the entire year. If you are using the other direct method also, you will get the same answer, students. Only thing is, say for the direct method, every time, 4 times you may have to compute, and lastly you may have to add the drawings on each one of it. Whereas here, you are not computing much. You are only creating a product as a shortcut, and then you may have to use a very simple formula, that is total product into rate into 1 by 12. Finally, one step in the computation will give us this interest on drawings for the year. There is one more question here before you. Biresh and Pawan are partners sharing profits and losses in the ratio of 2:1. Biresh withdrew rupees 2,000 at the end of each quarter. Interest is charged at 12% per annum on partners' withdrawal, and calculate interest on drawings of Biresh for the year ending 31st March under product method. See, what is the change you observe as per this question when compared to the previous one? It is also quarterly only. Quarterly indicates 4 times in the year. So naturally 12 divided by 4. 3 months once the money has been withdrawn by the partner. Well, in the previous question it said at the beginning of each quarter. When the question emphasized on the beginning of each quarter, we took the first of every month's date. That is, when you talk about April, 1st April. April, May, June is first quarter. When you talk on July, you have taken it as 1st July. But as per this particular question, the withdrawal happens at the end of each quarter. So when I say end of each quarter, what does this indicate, my dear students? You must take the last date of the completion of the quarter. See, the quarterly assumption remains the same. 3 months once is going to be the same in your minds. You start from April. April, May, June. We took beginning of the quarter means we took on 1st April. Here what you need to take? April, May, June, June 30th. That is last date of the quarter. I repeat, 3 months, our frequency is the same. April, May, June. Instead of taking it as 1st April, which happens to be the beginning of the quarter, you have to take it as 30th June. Similarly, what is the second quarter period? July, August, September. So which date you have to take? 30th September. Then October, November, December, you have to take 31st of December. And Jan, Feb, March, the date of withdrawal will be taken as 31st of March, last date. End of each quarter actually represents the last date of each quarter. I hope you understood this concept. Once you are ready with the dates, I think the rest of the flow of the sum is easy. Amount of withdrawal remains the same for each quarter. So therefore, I have taken 2,000 under every step. And then outstanding months. The calculation goes like this from the date. See, remember when you are not plotting the date properly, obviously your third column number of outstanding months also is a nut or flop it is. So your date of withdrawal must be computed correctly. That understanding should be clear in your minds. Then only this number of outstanding months also will happen correctly. So the number of outstanding months would be the same concept. From the date of withdrawal, the period up to 31st March. So here you start on 30th June. Students, when it says 30th June, do not consider the month of June. Because That is the last day of the month. 30th obviously means the last day of the month. And you don't have to take 1 month for the sake of 1 day. And we don't know which time of the day also that the withdrawal took place. So for the benefit of the partner, we do not consider the month, the completed month as such. So June should be avoided. You start the count from July only. 30th June 2013 means that month of June has to be avoided and you have to start the computation from July. So when you begin from July, it would be the count would stand like this: July, August, September, October, November, December, Jan, Feb and March. 9 months. So I have written it as 9. The next transaction, 30th of September. Again, September should not be taken. See, in the previous example, since we have taken it on the first of that month, we included that month also. Here, end of the quarter, meaning that last date of the month is taken, that particular month is being avoided. So here, September is avoided, October, November, December, Jan, Feb and March is a period of 6 months. Similarly, 31st December, so you check out December, Jan, Feb and March, 3 months. Look at this date, 31st March 2014 till 31st March 2014. Arey, then 1 day is still there. No, not exactly. That is taken as a 0 period. So probably like 5 o'clock closing time, they have withdrawn the money and gone. Will you cast interest, levy interest for 1 day? It is not sane. So 31st March 2014 till 31st March 2014 is considered to be a 0 period. Now what is the product all about? Column number 2 into column number 3. 2000 into 9 gives you 18,000. 2000 into 6 gives you 12,000. 2000 into 3 gives you 6,000. 2000 into 0 is 0, not 2000. I have seen many students going wrong here. So any number multiplied by 0 is always 0. And then you take the sum of the last column. 18,000 plus 12,000 plus 6,000 plus 0. That gives us 36,000. Work out on the formula. Interest is equal to total product into rate into 1 by 12. So your total product is 36,000. Rate is given as per the question as 12% per annum. So 36,000 into 12 by 100 into 1 by 12 is a constant term, I told you. So therefore, the interest on drawings would be taken as 360 rupees. So I hope this is a clear understanding on your part. Now, in the previous 2 instances, it has been given that the interest is to be computed on a quarterly basis. The first problem was upon beginning of the quarter withdrawal, and the second example that I took was on the withdrawal taking place at the end of each quarter. Now, is it that there should be an equivalent frequency among the drawings of the partner? That partner has to draw only quarterly or only monthly or only 2 months once? Not necessarily, because whenever there is a requirement for the partner, he can come and approach the business and he can take the money from the business for his personal use. So therefore, this quarterly, monthly, where a certain pattern of withdrawal is observed, we call it as regular withdrawals or regular drawings. Where the pattern is not observed, yesterday also he has withdrawn, suddenly today again he is in need of it, he will withdraw today also the money. So in such a case, we call it as irregular withdrawal. This particular sum, I am going to concentrate on the irregular withdrawal and how the interest on drawings and the product method could be done on this particular withdrawals. Look at this question. Prasanna and Pravina, 2 partners, and Prasanna's withdrawals is given to us. 4,000 rupees that Prasanna withdraws on 1st of June 2019. And 6,000 rupees on 30th of September. Similarly, 2,000 rupees has been withdrawn on 30th of November 2019 and 3,000 rupees has been withdrawn by Prasanna on 1st of January 2020. Calculate interest on Prasanna's drawings at 8% per annum for the year ending 31st March 2020 under product method. So the method is specified to us. The rate of interest on drawings is given. The date of withdrawal is given. The amount of withdrawal also has been supplied to us. In the previous two examples, have you observed the amount of withdrawal remained the same? 3000 or 2000, whatsoever it is, the amount of withdrawal remained the same. In this sum, the date of withdrawal is varying, the amount of withdrawal also is varying. So what needs to be kept in mind is the table formulation is the same. The 4 columns that needs to be developed for ascertaining the interest on drawings and the product method, we are going to follow the same method. We are going to draw up the table. Now the date of withdrawal has to be according to the sum given. Amount also take down very carefully against which date what money has been given has to be copied properly. So you get a table of this kind. So the heading would be calculation of interest on Prasanna's drawings using product method. What are the 4 columns that needs to be developed? Date of drawings, amount of drawings, outstanding period in terms of months and the product. So the date of withdrawal is supplied to us 1st of June and 30th of September, 30th of November and 1st of January 2020. Students, I hope you would have guessed the year on which we are talking, 2019 and 20. Our financial year as per this sum is 2019 and 20. 1st of April 2019 till 31st of March 2020. So the amount of drawings also has been supplied. I have taken it as it is. Now what is my next step? To calculate the outstanding period in terms of months. How do I calculate? 1st June 2019 till 31st March 2020. So start calculating from June. Include June also, because whenever I say first, that month, particular month has to be inclusive. I don't take April and May, only from June I should take. So June till 31st March 2020 would be a period of 10 months. Similarly, 30/9/2019. Don't include 9th month. 9th month is over. The last date happens to be 30th of September. So October, November, December, Jan, Feb and March is a period of 6 months. Similarly, 30th November, November should not be included. December, Jan, Feb, March gives a period of 4 months. And finally, 1st of January 2020 till 31st March 2020 is a period of 3 months. So the last column, product column, is to be ascertained by multiplying column number 2 and column number 3. 4,000 into 10, 40,000. 6,000 into 6, 30, 6,000. 2,000 into 4, 8,000. 3,000 into 3 is 9,000. And the total product, you add the last column and what you get would be 93,000. That is the sum total of the products. What is the formula given to us? Interest on drawings is equal to total product into rate into 1/12. So 93,000 into 8/100 into 1/12. So our total interest on drawings is given at rupees 620 rupees. So students, hope you might have got a very clear idea on the computation of interest on drawings. To sum up on this video, I introduced the word drawings to you, and more so our interest on drawings is being computed on the amount withdrawn. So I say that the property and the goods drawn from the business for the personal use of the business person also is inclusive of the term drawings. Here in our computation purpose, we assume that the money withdrawn by the partner would be taken for our calculation purposes. Now to proceed with, 3 methods have been introduced on the computation of interest on drawings. Direct method, with a very simple example, I have discussed this method, and on the way that we are doing this product method. So product method has 2 steps in its computation. First step tells us as to how the product has to be computed. The second step goes with the finding out of the interest on drawings using the formula total product into rate into 1/12. So work out on ample examples. My next lecture session would be on some more examples on this product method, and we would also discuss the third and the very important method, that is our average period method. Thank you students for listening, and ensure that you practice ample number of sums so that you become proficient in doing these kinds of sums. Thank you. Have a very, very good day. Bye.